The Construction Association of Michigan, CAM, has been helping commercial and industrial contractors and suppliers grow since 1885. Now's the time to join. Visit buildwithcam.com. If you're a construction company looking to grow, CAM offers resources to help you build your staff, find more projects, and expand your network. Join today. The Construction Association of Michigan. They're one industry, one resource, one CAM. Join today at buildwithcam.com.
Today's episode of CAM's Building Michigan podcast is sponsored by Priority Health, endorsed health insurance carrier for CAM members.
So right now, we've all been feeling lots of shifts in our lives. We've gone from crazy busy schedules to way more time with our loved ones, from commuting to the office to working from our couches. And that's okay, because Priority Health is always ready to shift right there with you. So whether you're experiencing a shift in employment or you're prepping for a new member of the family to arrive, Priority Health has you covered. Priorities shift, so maybe it's time your health insurance company did too. Find your plan at PriorityHealth.com.
It's that time of year. Time to review your workers' compensation plan and shift to coverage that pays you back. CAMCOMP, part of the Construction Association of Michigan, is the state's leading self-insured group designed for the construction industry. The safer your employees, the more money you get back. The average payback to members is 45% of their premium, a very smart investment. Find out how safety pays with CAMCOMP. Call Juan Ramirez at 586-790-7810 or go to www.camcomp.net.
Hello, and welcome to our 14th episode of the Building Michigan podcast, produced for Michigan's construction industry by the Construction Association of Michigan, CAM. My name is Kevin Koehler. I'm the president of CAM and your host for Building Michigan. Our podcast is designed for the construction industry here in the Great Lakes state. Each 25 to 30-minute episode will feature conversations on industry topics, including a variety of conversation with industry leaders discussing construction projects, trends, business development, legislation, and other industry-related topics. Well, let's get started. This is Season 2, Episode 14. Today's episode features a conversation about employee stock ownership plans, or ESOPs, with industry experts Jeffrey Jamerino and Jeremy Garrett from Lazear Capital Partners. Before we get started, I'd like to introduce the two of them to you. First off, Jeremy, Jeff, welcome to the show.
Thank you. Glad to be here.
Thanks.
Jeremy, welcome to the show. And why don't you tell us a little bit about yourself and what makes you an expert on ESOPs?
So I'm a managing director with Lazear Capital Partners, founded the firm's office in Michigan. And prior to joining Lazear Capital 6.5 years ago, I spent over 17 years in middle market banking. Since joining the firm, I've closed over $1 billion in ESOP transactions throughout the country. And I'm joined here with my friend and colleague, Jeff Jamerino.
Hey, Jeff, welcome to the show. Why don't you tell us a little bit about your background?
Thanks, Kevin. Yeah, so I started my career in public accounting. After leaving public accounting, I joined an electrical contractor and spent almost 30 years of my career with that electrical contractor. First as the CFO of the company, and during that time the employees bought the company and created an ESOP, and then eventually I took the company over as the president and CEO of the company, and ran that very successfully until last year when I left the firm and decided to join Lazear Capital.
So you have both sides of the business. You have the business acumen, but you also are in the construction field and transitioned your company into an ESOP. So what better person to have here with us today than someone who's been through it, from the ground up.
Exactly, yes.
So that's what makes the two of you experts. Jeremy, tell us a little bit about Lazear Capital Partners, who you are, what you guys do, and why the ESOP thing is your forte.
Yeah, Lazear Capital Partners was founded 23 years ago. Our headquarters is in Columbus, Ohio, and but we've got 10 offices. Again, our office is in Birmingham, Michigan. And we, in the past 12 months, have closed over $2 billion in ESOP transactions across 34 different companies. We employ 35 professionals on staff, ranging from disciplines in accounting to tax law, banking, valuation, and also former CEOs of businesses. We're very well known in the construction space. Probably over 50% of the transactions we do on an annual basis are with contractors. So we're well known by all the bonding companies, the sureties, CPAs that specialize in accounting, and banks that lend into the construction space. And we're known as the go-to investment bank for ESOPs, particularly in Michigan. We publish a newsletter called The Unlock, and we speak at ESOP conferences throughout the country.
I know several CAM members that have gone to ESOPs or use ESOPs, and I know you guys have shepherded them through that process. Jeff, before we get too deep into everything that we're going to talk about, give us some basics on what is an ESOP for the listeners out there that might know the word, know the terminology, but what really is an ESOP? What makes up an ESOP?
Yeah, so technically it's an ESOP is an employee stock ownership plan. It's a government-sponsored retirement plan. Think like a 401k. It's governed by ERISA, which is the law that governs things like IRAs and 401ks. So technically it is a retirement plan for the employees. In practice, what happens is a owner or owners of a company choose to sell that company to the employees, and then the employees benefit from the future success of that company by accumulating value within their accounts as a retirement asset.
So as an owner, and we have a lot of owners that are my age or younger that are transitioning out or looking for ways to maybe keep their company going, but transition their business, and maybe they have some key employees, maybe they don't. But an ESOP is an option for them, right? A way to transition your business for continuity and to keep the business moving forward.
Yes, from an owner's standpoint, what everybody thinks of all the time are third-party transactions, and that can be selling your company to a strategic buyer, selling your company to a competitor, selling your company to private equity, and those are the traditional routes that owners think of when they go to sell their company and have that transition event. However, ESOP is just another one of those options. Unfortunately, I think a lot of people aren't aware of what an ESOP is and the power of what an ESOP can do, both for the selling owner of the company as well as for the remaining employees that stay with the company. So there are all kinds of benefits from a tax standpoint, from a culture standpoint, that accrue both to the company and to the seller that they wouldn't get in a normal third-party transaction.
Right. So, Jeremy, I guess that kind of why would an owner select it? I mean, I think Jeff's hit on a few of those topics now, but why would an owner select an ESOP over maybe another traditional method of sales?
I think particularly in the construction space, what you'll find is after-tax sale proceeds almost always exceed what you would get in a third-party sale to a strategic competitor or private equity company when you sell to an ESOP. So the number one thing is really that your after-tax proceeds, because of the tax advantages of an ESOP, and the fact that you don't get all your money at closing, you get it over time, and the money you don't get at closing, you get a 12% return on typically. So when you add up the benefits of the fact that the sale price will probably be roughly the same, but you're not paying tax on the sale, plus the fact that you're getting interest, plus warrants, you add all that up, and it typically exceeds what you would get from a private equity or strategic competitor. Other things are, a lot of business owners that we talk to are not quite ready for retirement. But they understand that now is a good time to sell. Multiples are near all-time highs. Banks are still lending, and so it's still a good time to sell, particularly to ESOPs, and it allows business owners that we're dealing with a transition or like a soft landing from working 40 to 80 hours a week down to zero ultimately over the course of typically 3 to 5 years. So it gives them a little time to stay active in the company, to have that soft path to retirement, and eventually fully retire. At the same time, with a third-party sale, if you've got a good management team, you've got a good CFO, you've got maybe a COO, and a number of other executives in the company. Well, new company, the acquirer typically doesn't have a need for that executive team or management team, and so there's a lot of redundancies that happen when you've got a merger. Ultimately, usually it's the seller's management team that will eventually go away. With an ESOP, they stay put. They get a huge reward in the form of stock appreciation rights and participation in the ESOP. And then also all the employees will stay put, and they'll get a reward in the form of the ESOP participation. So, a couple different reasons why, we see business owners selling to ESOPs versus third parties. In addition to that, you've got, certainty of closing. So, there's some statistics out there, they range, but they say that, of the businesses that go to market and try to sell their company, 70, 80% of those transactions fail. And I wouldn't doubt if it's higher than that in the contracting space. And with an ESOP, you've got a highly certain buyer that's a guaranteed buyer that's sitting there, and that's your employees, and an ESOP. And so when we start a transaction, from the time we start it to the time we close it, it's typically only about 4 months.
Oh, wow, that's a lot quicker than I thought it would be.
Very quick, yeah. So with a third-party sale, you're looking at kind of 6 to 12 months with a low certainty of closing. With an ESOP, you're looking at 4 months with nearly 100% certainty to close.
And I think we touched on it, but another advantage is that it's continuity of the company name, continuity of the business, and you're rewarding, your employees. Or I don't know if rewarding is the right word, but you're kind of, handing over the reins to your employees to keep the company moving.
Yeah, Jeremy touched on legacy a little bit, but that's what you're referring to, is that legacy. You're going to leave the company intact. That company name, that organization is going to continue to thrive and exist. You'll be able to drive past it every day and point at it and say, there's that company that I used to own, and be proud of that. You're going to leave, as Jeremy said, nobody's going to lose their job in a transaction with an ESOP, because you still need everybody to continue to run that company. There is no redundancy that takes place. So everybody stays in place and stays intact. And then, as you said, there's huge rewards for the folks that helped that owner get to the place that he's at. And so they're going to benefit from ownership in the company. As Jeremy touched on, there are stock appreciation rights and other ways of rewarding the executive team. So, everybody gets taken care of in the big picture.
When we talk about rewarding the executive team, and you've got your executive team, obviously, and then you've got all of your employees. And Tim, I think you had asked me a question about ESOPs. Maybe you can ask the guys about the level of participation for all your employees. Maybe you can...
Yeah. So I was wondering, from an employee standpoint, how are they rewarded with with the ESOP plan? Is their compensation through this based on their existing salary, or is it like an equal share? Like if there are 100 employees at a company, does everyone get a 1/100th share of the company, or is it based on their existing compensation? Is it proportional?
Yeah, so you touched on it initially. It is proportional. So it's, in essence, your wages compared to everybody else's wages, and you're going to get a fraction based on your compensation of the shares that are available each year to be allocated out to each person's account. So think that a person that makes, say, $50,000 a year will get half the shares that a person making $100,000 a year would get.
Okay, yeah.
Very similar to a 401k, right? If you're putting 10% of the employee's income, I'm just throwing that out. Not many 401ks do that today, but if you put in 10%, everybody gets 10%, but it's commensurate on how much you're being paid, too.
Exactly right. Yep.
Yeah, the big difference between a 401k and an ESOP is that most of the money that goes into a 401k comes out of the employee's pocket. With an ESOP, it's a free benefit. So they receive a free benefit on an annual basis, stocks in their, shares of stock into their account. that grows in value over time as the company pays down debt and increases the value through increased profitability. So although they're fairly similar in the fact that they're both retirement accounts, an ESOP's a free benefit versus a 401k where they got to pay.
So when someone liquidates their ESOP, are they taxed on that? Is it a taxable?
Yeah, so as shares accumulate each year, and as we talked about, they get allocated out each year, there is no tax impact to the participant in the plan. And then at retirement, or when a person leaves, it's just like a 401k plan. So that money at that point in time can be rolled over into an IRA or into another plan. Or withdrawals, you can start taking withdrawals out of the plan, and whatever you withdraw from the plan then becomes taxable income in that year. Yep.
Can companies have an ESOP and a 401k?
Yes. As a matter of fact, at our company, we did exactly that. So we had a 401k that we had in place for 25 years. We didn't change that in any way, and then just added the ESOP as another layer of a retirement benefit on top of that.
ESOPs are a great retention tool. So over time, as that participant account grows in value, employees become stickier and stickier and want to remain with the company for a longer period of time. And the statistics show that for every 7 employees that leave traditionally owned companies, only 1 employee will leave an ESOP. So if retention and attraction of talent is an issue for your business, you should think about potentially selling to an ESOP.
I mean, that's a huge statement because I think all of us know, Jeff, I know you know for a fact, and Jeremy, I'm certain you are aware of it too in this industry. I mean, retention and finding qualified people to fill the positions that we have open is a major concern today, or hugely important. So to have one more arrow in your quiver to keep maybe arrow's not the right word, but one more reason to keep your employees, wow, that's a bold statement. I mean, for every 7 that leave traditional companies, you only have 1 leaving that are tied to an ESOP. So that's another huge value, not only to the employees, but to the employers.
It was an interesting thing to watch at our company as time went on and people's balances started to accumulate more and more shares in their account, and the value of those shares started to rise. It really grabbed people's attention. It changed the way they thought about the company and what their long-term plans were. And it also encouraged them to talk to the newer folks and encourage them and make sure that they understood what they had and realize that they had that golden goose that they needed to take care of.
They have ownership, right? I mean, they have a stake in the game, which is really pretty cool. So, guys, is there other benefits to employees? I mean, obviously, there's huge benefits to the employers or the people the people that get the ESOP going, and the employees have the added benefit of a benefit, really, a pretty cool benefit. Is there any other?
Yeah, there's really 2 major tax advantages. One we spoke of, which is the fact that a selling shareholder can sell his or her company and not pay capital gains tax or ordinary income on depreciation recapture. That's the first major tax benefit of an ESOP, and that's intended to encourage more business owners to sell to employee stock ownership plans. The other tax benefit, though, to help companies that become ESOPs is the fact that as an S-Corp that's owned by an ESOP, the company will not pay any federal and state income tax. And the reason for that is because the S-Corp is always a pass-through. The income passes through the S-Corp up to the ESOP trust. ESOP trust is considered a qualified retirement plan, and that does not pay any tax either. So then you've got 2 non-tax paying entities. And so, Jeff can speak to this in a minute about just the power of a company not having to pay taxes. So, simple example, if you have $10 million in profit, you typically would make a distribution to the owner. That distribution would ultimately end up in the government's hands. That distribution would be $3.5 million to $4 million in taxes on an annual basis. Post-closing, as an ESOP-owned firm, there is 0 tax paid, so all $10 million stays in the company. And that can go to pay down debt. It can go to acquire companies, acquire assets,
new equipment. Investing in your people. That's hugely important, I think.
Yes, that cash flow, that additional cash flow, is huge. It's really what drives the ability to create the ESOP transaction. The amount of debt can seem daunting at first when people look at what it's going to cost to buy that company from the former owner. However, when you look at the increased cash flows because you aren't paying income tax, you realize that the payments really aren't that difficult to make because you do have that additional cash flow. And once that initial debt is paid down, that's when the real power of the ESOP takes off, because now you can start taking that cash, and instead of making debt service payments, now you, as you said, you're making investments in your people, you're making investments in your equipment, you're going out and making strategic acquisitions to grow the company and push the company even farther in its pursuit of success.
Seems like that would be a huge competitive advantage too if it's properly played, right? I mean, against guys who have to pay tax and are putting that $3.5 million.
You've got a 40% advantage over those other competitors.
Absolutely.
So it's huge.
A lot of our business owners ask us if it's legal, and it is absolutely 100% in the IRS code. So
that leads me to my next question. I guess, Jeremy, maybe you can answer this. Jeff, you can pipe in. But like political support, is there any? I mean, as far as political support goes, maybe on a national level, on a local level, how is it today? Are legislators in favor of this?
Yeah. Both sides of the aisle, Republicans and Democrats, agree that ESOPs are a good thing for the United States. One, they encourage, it can encourage more business owners to sell their companies to ESOPs, with that tax benefit to the selling shareholder. But then, two, the government understands that Social Security is getting strained. Most people are not saving for retirement. And essentially what an ESOP does is it broadens the ownership of a company from one or two owners out to hundreds or thousands of owners. And so both sides of the aisle, Republicans and Democrats, see the benefit in that. And the legislation that's intact today with the tax benefits for the seller and then also for the company post-closing have been in place for decades. So nothing's changing. And at the same time, on a more local level, some states are adopting different ESOP programs to encourage more businesses to sell to ESOPs. So I know Michigan's got a few things on the docket, and then Colorado passed some legislation recently. There's a number of different states that have.
So it sounds like there's a lot of people in support of this. I know several companies. I know you guys have worked with several of our member firms. You guys are members as well. But, I mean, you've worked with several of our contractor members to move them into ESOPs. Why aren't people knocking down your door to do this when they're looking to sell? Is it more complicated than a third-party sale, or is it just educating people on it? Or
those are great questions, Kevin. And, is it more complicated? No. Any sort of a transaction where you're selling a corporation, you've got all kinds of moving parts. You've got hard assets. You've got real estate assets. You've got people. You've got intellectual property. All these different things. The transaction is complicated no matter who you're selling. Whether you're selling it to your employees, whether you're selling it to private equity, you're selling it to a strategic buyer. It doesn't matter. Those are always complicated transactions. So I don't think there's any more or less difficulty to an ESOP compared to those other types of transactions. What I think is that for whatever reason, and I'm not sure, we need more education about ESOPs. There are just a lot of business owners out there that just either they've heard the words and either are concerned or don't understand it, or just don't know anything about it. And that's part of our mission. And I know Jeremy and I talk about it all the time. We just really want to get in front of business owners and have the opportunity to tell them what an ESOP's about and what sorts of benefits can accrue to both them and to their employees. And then they can make the choice. They can decide which direction they want to go, but at least make an informed decision.
Sure. So when a guy's getting ready to sell his business, he usually calls his attorney or his CPA, and if they aren't aware, which in today's day and age it'd be hard to believe they haven't heard the word ESOP before, but if they aren't aware, they're going to direct them into a straight third-party sale, or they're going to encourage them to do that, or what have you. So you guys, are continuing to educate, and I know that you're going to be interviewed in CAM Magazine in the months to come, so there'll be some articles there. I know that the two of you have offered to do seminars and some training, and I know you're available to any contractors that may be interested, including probably CPAs and whoever is working with those transactional type arrangements, right?
Yeah, for sure. And, from a CPA, a banker, or an attorney's perspective, having your client sell to a third-party buyer means you lose a client, right?
That's a great point.
Listen
up, folks.
When the company sells to an ESOP, they retain a client, and typically there's just a slightly higher level of fees on an annual basis for ESOP companies. Just they're slightly more sophisticated and complex, but so the CPAs out there, the bankers, the attorneys, for your clients, what I can say is think about an ESOP, think about retaining your client, think about the benefits that it can provide to them, the family of the selling shareholders, and the employees. And going back to a question you had, Kevin, on why don't some business owners sell to ESOPs and where it may not be a fit. I do want to cover that too. So, where we see an ESOP not fit is when you've got a strategic buyer that's willing to pay north of kind of 10 to 12 times and above, 10 to 12 times their EBITDA and above, in an all-cash sale. And with an ESOP, you have to be patient. So for your proceeds, many times, if you've got a buyer willing to pay 10 to 12 times EBITDA and above, you should just sell that company, take the cash, and if you really care about your employees, or the thought of it's hard to stomach the fact that you're selling out. Stroke them a check on the way out. But in those scenarios, we see an ESOP not be a great fit. 10 to 12 times plus multiples. In the contracting industry, though, they're really
hard to find that kind of multiplier. So, is there a dollar vet? I mean, is like a $1 million company is good for an ESOP as a $100 million, or is there like a better fit, if you know what I mean? Yeah,
the best fit is really for companies with kind of $2 to $3 million in EBITDA and above, and over 20 employees and above. And the reason for that is because typically you've got a deeper management bench that's in place at that point, and they can then kind of handle some of the complexities of the ESOP after the sale better than smaller companies.
That makes sense. So is there a type of contractor that's a better fit, or Jeff, I know you were an electrical contractor. I maybe that's a silly question, but is there?
Yeah, I think in general it fits almost all contractor areas. I don't think that there's one that's better or worse than another. There are some very niche, very specific areas in contracting that do sometimes demand a very high multiple. And going back to Jeremy's comment, it probably doesn't make sense for them. Mm-hmm. But in most cases, whether it's a general contractor or a specialty subcontractor, it usually can make a lot of sense.
ESOPs can be great for heavy asset companies, road pavers, those types of companies, where you've got a lot of assets that have been depreciated over time. Typical thought is that the tax on the sale of your business is in the state of Michigan 20% Fed, 4.25% state, so 24.25% combined as your capital gains rate. Problem is, if you've depreciated a lot of your assets over the years and you've got a lot of depreciation recapture, that is taxed at ordinary income rates of 35+%. So then for heavy asset companies, you start getting up to a blended rate of about 30%. And if you can, on a $100 million sale, avoid $30 million in tax and have a 12% rate of return on the seller note that's owed to you, that kind of 100 minus 30 million in tax, that $70 million deal with an ESOP starts looking like a $120, $130 million deal. So nearly a 60 to 70% increase in the total sale proceeds.
That's really impressive. Anything else, Tim? Are you thinking of anything right now that you'd like to ask? Or
yeah. So, Jeff, earlier you briefly mentioned the word culture, and I think company culture is kind of a hot topic nowadays, and you have that firsthand experience of seeing a company transition to an ESOP, and I'm wondering what type of impact does that have on the company culture?
Yeah, that's a great question, Tim. Thank you. It really, when a company becomes employee-owned, culture really becomes everything. It becomes the driver to everything that you do, because now instead of working for the man, right, and working for somebody else, you're now working for yourself.
I see pointing at me when you says that.
When you can start to educate people and make them understand that everything that they do has an impact ultimately on their retirement and on the future success for their family, and how powerful that can be, it really starts driving people's behavior. And if you foster that and build that culture around, let's work together, let's be a team, let's do what's best for the company in order to drive enterprise value ultimately. It
seems like it would be a real driving force.
It's a real
to rally
driver,
around,
not only financially, but it just changes the whole mindset inside the building too. It just people just become. I don't know how to even explain it, but it's palpable.
See, Tim, we're an association, so we can't do that, but it would be cool, wouldn't it?
Yeah, I can imagine it would have a big impact on just day-to-day, the way that employees think about going to work, just having that extra retirement bonus, and just realizing the way that the company is performing is going to tangibly affect the way that it affects that employee. It's like a direct benefit for them.
That's exactly right.
Absolutely. So, guys, kind of wrapping this up or getting closer to the end here, walk me through the role that Lazear Capital would play in helping to transition a company to an ESOP.
Yeah, our approach is fairly simple. So, first couple calls, we start with the client, learning about them, their goals of a transaction, learning about the business to see if an ESOP may be a fit for them. And then, if we feel like it may be, we'll take them through an ESOP 101, which really covers the high-level aspects of an ESOP. And then they'll start understanding that, how an ESOP works and what it, what it might mean for them. And then if they are still interested after that conversation, we'll do what's called an ESOP feasibility analysis. So we do this on every transaction. We never skip this process. And what the feasibility analysis will do is provide the certainty of the outcome that a business owner is looking for in terms of what is my value, how much bank debt can I obtain, how long is it going to take to get my money paid to me, what's the benefit for my employees, what's the tax impacts of the sale, all the different aspects of what you would think of as a selling shareholder. We'll walk through all those items in a feasibility analysis. And then from there, if a business owner says, yep, this is the way I want to sell my company, we will start the sale process to an ESOP, and we will help them with every aspect of the transaction, ranging from securing bank debt to restructuring the company to making sure that they're obtaining all the tax benefits they should. We've got alternatives for what's called a 1042 exchange, which is where you can sell the company on a tax deferred basis, much like a 1031, just slightly different for an ESOP sale. So we'll walk through all the different intricacies of an ESOP, help them make sure that the ESOP plan design is made in a way where it's sustainable. And we're doing all that during the sale process within a 4-month period. We do that because the old saying is in mergers and acquisitions and ESOPs is that time kills deals. And so you want to, when you start the process to sell your company, you want to close that transaction as quickly as possible. And that's what we do for clients.
Just kind of summarize what Jeremy just said, Lazear is the quarterback, right? We pull all the different members of the team together. We coordinate everybody. We make sure that we're all on the same page and that we're pulling in the same direction. Again, going back to his point of time, that's how we get it done as quickly as we do, because we're coordinating all those players.
This might be an inappropriate question, but is it expensive to do this? I mean, how do you guys? I assume
the
people
cost,
pay.
Yeah, the cost of doing an ESOP, selling your company to an ESOP, are somewhat equivalent to what you would pay for a merger and acquisition of your company. So a sale to a third party.
So equivalent to the same. You're going to have to hire similar type people to coach you through that as well. So
yeah. So the big difference is that with a sale of your company to an ESOP, ultimately the costs of the transaction are borne by the ESOP itself. So, again, going back to the $100 million sale company, that value, typically you would pay third parties, an attorney, maybe a CPA, and an investment banker. We'll call it a couple $1 million in fees to sell a company like that. Well, the selling shareholder ends up with $98 million with an ESOP. They'll actually end up with $100 million. So the ESOP ends up picking up the cost of the transaction. So big difference.
There's another big benefit too.
Yeah.
So guys, we're getting close to our time here, and at the end of these episodes, I'd like to ask each of you or ask our guests if they have any, departing words of wisdom for our listeners out there in construction land. So Jeff, let's start with you. Any thoughts on?
Yeah, the big one for me is education. I encourage all business owners to learn about ESOPs. Maybe it's not the right fit. Maybe it's not the right way to go. And Lazear's here to help with that. And we don't care. We do care, but make a decision. But at least make an educated decision about what direction you want to go.
At least educate yourself about the ESOP option.
Exactly.
And I mentioned it before. I know we've got some articles coming up in CAM Magazine that you guys are helping us with, and I know they can reach out to you, and we'll give out your email address here in just a second. Jeremy, any thoughts on that? And maybe you can give the email address and the contact information out as well.
Sure. So I would just leave everyone with the fact that despite M&A activity being off 40% from 2022, ESOPs are still a very viable way to sell your company. And we, in the past 12 months, we've closed over $2 billion in transaction. We're expecting to close over $3 billion in transactions in 2023. So
wow.
There's a lot of people are out there thinking about selling, wondering if it's the right time. Well, more likely than not, it is the right time. And if you're thinking about a transition of ownership in the next 3 to 5 years, well, why not get started now? With an ESOP, it typically takes 3 to 5 years to get paid off. So, if you're thinking about it, possibly do it now. If anybody has any questions or wants any advice, you can reach out to myself or Jeff. Our emails are, mine is pretty easy, so it's Jeff's. Mine is jg@Lazear Capital, LazearCapital.com, and Jeff's is jj@Lazear Capital, LazearCapital.com. We're happy to answer any questions any of your members have.
Perfect. And, we're going to post the podcast on our podcast channel and on the website, so there'll be links back to you guys there as well, so people can listen to this episode and reach out to you that way as well. Well, before closing, guys, I'd like to remind our listeners to come out and join us for the CAM Mid-Year Economic Forecast Breakfast on Thursday, June 20th at the Suburban Showplace in Novi. Our featured economist is Elliot Eisenberg, known affectionately as the Bowtie Economist. He is a must-see. He's really funny when it comes to, talking about the economy and those kinds of things. This guy's good. The registration information is available on the CAM website at buildwithcam.com or by calling Patty Shear at 248-972-1000. Jeff, Jeremy, on behalf of all of us at CAM, myself, our producer Tim Andrews, thank you for being with us today on CAM's Building Michigan podcast.
Kevin and Tim, thanks for having us.
Thank you.
Great job, guys.
Thank you for listening to Building Michigan, the official podcast of the Construction Association of Michigan, hosted by Kevin Koehler, CAM President. We appreciate you spending a part of your day with us. If you have a second, please share our podcast with industry colleagues, leave us a review, and connect with us at www.buildwithcam.com. That's all for now. Be sure to subscribe to Building Michigan wherever you get your podcasts and join us for the next episode.
Today's episode of CAM's Building Michigan podcast is sponsored by Priority Health, endorsed health insurance carrier for CAM members.
So right now, we've all been feeling lots of shifts in our lives. We've gone from crazy busy schedules to way more time with our loved ones, from commuting to the office to working from our couches. And that's okay, because Priority Health is always ready to shift right there with you. So whether you're experiencing a shift in employment or you're prepping for a new member of the family to arrive, Priority Health has you covered. Priorities shift, so maybe it's time your health insurance company did too. Find your plan at PriorityHealth.com.
It's that time of year. Time to review your workers' compensation plan and shift to coverage that pays you back. CAMCOM, part of the Construction Association of Michigan, is the state's leading self-insured group designed for the construction industry. The safer your employees, the more money you get back. The average payback to members is 45% of their premium. A very smart investment. Find out how safety pays with CAMCOM. Call Juan Ramirez at 586-790-7810 or go to www.camcomp.net.
The Construction Association of Michigan, CAM, has been helping commercial and industrial contractors and suppliers grow since 1885. They provide contractors leadership through aggressive lobbying, construction project reporting, safety and education training, industry promotion, insurance, and banking. Are you an owner, developer, or buyer of construction services? Hire a CAM member to get your project done on time and under budget. They are one industry, one resource, one CAM. Check them out at buildwithcam.com.